Good morning, everybody. So today's video is going to be relatively quick because the week was very short, with US and UK market closed on Monday and most Nordic countries and Switzerland closed on Thursday. So overall, we are just going to make a quick update on what's happening on the S&P 500, which is a continuation of the consolidation process. And also, I'm going to focus on what's happening on the Euro Stoxx 50 to show you that the technical breakdown we saw this week is rather misleading. So first of all, on the S&P 500, so what's happening right now is a continuation of the consolidation process in line with what I discussed over the previous weeks. What we can notice is that the technical bounce we saw last week was relatively disappointing, with the index failing to break above the 2900 area. And renewed weakness this week, back below an important support zone, which was between 2810 and 2800. And you can see that. So a continuation of the correction, with the index now challenging its 200-day moving average. So you can see that overall we very often see technical bounce attempts near this 200-day moving average. So that's what we saw at the end of last year for 2 months, and a nice bounce from this moving average in March. So it's possible that the index will try to bounce off this moving average in the short term. However, I wouldn't call for the start of a strong rally from here because the market is not outright oversold, except the sectors that have suffered a lot, like semiconductors. So the technical outlook is still rather neutral to negative in the short term. And if this 200-day moving average does not hold, I would expect the index to go to the next Fibonacci support, which is at 2722. So this is a level I already highlighted previously. So preference would be a continuation of the consolidation to this next Fibonacci support. If we now switch to the Euro Stoxx 50, so some technical analysts highlighted this week, so it was on Thursday, that the index dropped below an important support zone and even validated a head and shoulder pattern. I just want to warn you about this misleading pattern. Because, I mean, this is the Euro Stoxx 50 cash index, and this cash index does not take into account dividend payments. And right now, we are in the heaviest period of dividend payments. So there is a technical effect, negative technical effect on this index. If we retreat this negative technical effect, we can see that the Euro Stoxx 50 is still pretty high. Much higher than what we can see on the cash index. It has retraced a bit more than 23% of this year advance, which means that the correction is not so strong, and that it can easily continue to the next support zone, which you can see it here, corresponds to Fibonacci support, is the 200-day moving average, and you also have these lows of March. So a quite important support zone. I think the risk is to extend the correction within coming weeks to this next support zone. So in the short term, we cannot really say that the market is oversold. Of course, it can bounce back, but I wouldn't expect at this stage the start of a major recovery from here. If we end this quick presentation with an update on what's happening on DAX, you can see, like the Euro Stoxx 50 dividend included, that this is a dividend included. This one, DAX, is dividend included. You can see that this week we had a bearish gap when breaking below the 50-day moving average for the first time since late January. So this is a warning that the index is weakening and may continue to decline. And obviously the next potential downside target is around 11,600, which is the next Fibonacci support and the 200-day moving average. Longer term, what we can see is that markets are taking a breather. Probably they rose too far too fast, but I wouldn't call yet for the start of a big sell-off. The reason is we had in April a nice golden cross which invalidated the death cross signal. So these are crossovers between 50 and 200-day moving averages. So the fact that the latest signal on these moving average is a bullish signal shows that we at this stage we just have a pullback after a strong rally. The rally was probably too strong to be sustained, and now we are taking a breather. So not an outright bearish message, just a continuation of the correction in the near term. Thank you very much for listening and have a great weekend.